How will we power the artificial intelligence revolution when our terrestrial electric grids are collapsing under the weight of computation? The answer arrived just days ago, on June 12, 2026. SpaceX executed the largest initial public offering in financial history, but when the paperwork cleared, they didn't file as an aerospace company. Under SEC industry code 7370, they listed themselves strictly as a data processing firm. Following their February 2nd merger with xAI, SpaceX made it clear that 85% of their $28.5 trillion total addressable market is now dedicated to artificial intelligence. They hit a hard macroeconomic wall. Earth's legacy grids can no longer support a 1.96 gigawatt data center, meaning the future of the cloud relies entirely on the unfiltered solar energy of low Earth orbit. For most of the last decade, the global technology sector was trapped in a highly destructive cycle of capital misallocation. The world's most powerful conglomerates held unprecedented cash reserves. But instead of real structural innovation, they burned billions trying to force consumer hardware revolutions the public simply did not want. We watched this play out repeatedly. The financial damage was catastrophic. Apple quietly surrendered its ambitions for a proprietary electric vehicle. They abandoned a secretive 10-year initiative that swallowed billions of dollars in research and development without ever putting a single functional car on the highway. Amazon flooded the consumer market with highly subsidized smart devices, trying to place voice assistants in every single living room and kitchen. That strategy triggered a staggering $25 billion structural deficit for their hardware division between 2017 and 2021. Meta took severe reputational and financial damage to pivot their entire corporate identity. They posted a massive $5 billion operating loss for their Reality Labs division in a single fourth quarter. It was a desperate bid to build out early virtual world infrastructure. Even the transition to autonomous transit became an endless capital sink. Alphabet's self-driving unit required an immense $5.6 billion funding round just to maintain its operational footprint, as the fragmented robotaxi market severely strained their balance sheets. These were all highly speculative terrestrial hardware bets. The industry was practically setting money on fire. They were desperately searching for the next smartphone-level paradigm shift. But then, the paradigm actually shifted. Generative artificial intelligence arrived. Almost overnight, the underlying capital requirements of the tech sector changed from speculative consumer research into an existential infrastructure mandate. Training these foundational language models evolved from a multi-million-dollar corporate expense into a sovereign-level financial burden. When OpenAI trained their early generative architectures, the compute cost hovered around $4.6 million. But by the time they deployed their next-generation multimodal systems, those exact same run costs skyrocketed well past $100 million for a single training run. The underlying silicon required to run these massive mathematical models demands immense, sustained funding. That effectively blocks out any new competition. Nvidia alone poured nearly $10 billion into the research and development of a single generation of its new Blackwell chips. This forced an insurmountable technological barrier to entry onto the rest of the market. To keep pace with this accelerating hardware arms race, hyperscalers have forcefully redirected capital away from consumer divisions. They are heavily leveraging their core, cash-generating businesses. Alphabet's advertising engine consistently brings in over $200 billion annually. This is the primary high-margin liquidity provider for their absolute frontier AI ambitions. At the same time, Amazon has pushed its long-term research and development expenses into parabolic territory. They are purposely sacrificing short-term, quarterly profit margins. They need to ensure they maintain a strict baseline of infrastructure dominance moving into the 2030s. But as the dust settled on the finalized merger between SpaceX and xAI on February 2nd, 2026, the broader financial markets woke up to a chilling realization. SpaceX had successfully achieved absolute orbital dominance. They drove launch payload costs to the floor through rapid reusability. But they discovered that the real operational bottleneck of the late 2020s isn't rocket fuel. It isn't payload capacity. It isn't even silicon. It is electricity. We are now officially entering the era of the orbital energy arbitrage. The baseline power requirements of hyperscale AI infrastructure have completely broken the physical limits of our century-old legacy electric grid. Global data center electricity demand is doubling year over year. This puts regional utility operators in a nightmare scenario. They must somehow add over 400 terawatt hours of net new generation in a matter of months just to keep the regional lights on. This crisis is driven by an unavoidable shift in hardware architecture. The technology industry has rapidly moved away from scattered, fragmented servers toward massive, centralized computing environments. Single technology companies are now assembling monolithic, tightly synchronized server clusters. These routinely exceed 24,500 highly advanced GPUs operating continuously under a single roof. When you look at the raw electrical draw of these facilities on a global scale, the geographic imbalance is staggering. The United States is absorbing an astronomical load. It pulls roughly 260 million megawatt hours from the grid just to keep domestic servers operational and the data flowing. That is a massive structural burden. It completely dwarfs the 138 million megawatt hours consumed by competing state-backed facilities in China. Meanwhile, smaller European nations are feeling the strain intensely. Ireland, for example, is watching 18 million megawatt hours of its own localized power supply get completely absorbed by foreign hyperscale infrastructure. The grid simply cannot balance this weight. The physical footprint of these mega facilities reveals an extreme centralization of computing power. It is reshaping global real estate. Right now, the United States controls the lion's share of the market. It houses exactly 51% of the world's entire hyperscale data center capacity firmly within its borders. This is a massive consolidation of technological leverage when compared to China, which currently holds roughly 16% of the global footprint. Over in Europe, major industrial manufacturing hubs like Germany only maintain about 6% of this infrastructure. The localized electrical burden on the American utility grid is unlike anything we have ever seen in modern industrial history. A next-generation 1 million GPU cluster requires between 1,000 and 1,960 megawatts of continuous power. To understand the gravity of a 1.96 gigawatt draw, you have to realize what that means. A single AI facility now consumes the exact equivalent of a massive, commercial-scale nuclear reactor. This completely breaks a fundamental century-old engineering concept known as load diversity. Think of a major city's municipal water system. The underground pipes, the pumps, and the reservoirs are built on the mathematical assumption of random, staggered usage. Not everyone in the entire city wakes up, jumps in the shower, runs the dishwasher, and waters their front lawn at the exact same millisecond. Because human usage naturally spreads out over 24 hours, the overall system pressure remains stable. But an AI training cluster does not sleep. It is the equivalent of every house in a major metropolis, opening every faucet to maximum pressure at the exact same moment, and leaving it running continuously without a single break for 6 straight months. The legacy grid was not designed to handle that synchronized electrical draw without failing. These massive compute clusters swing their power demand by hundreds of megawatts in mere seconds. Because of this, they face severe 2 to 10 year interconnection delays from overwhelmed regional grid operators. In response to this gridlock, technology conglomerates are aggressively exploiting a massive regulatory blind spot known as behind-the-meter generation. Imagine you run a massive manufacturing plant. Instead of relying on public highways to receive your daily supplies, you buy the empty land next door. You build your own private cargo airport and monopolize all the incoming freight. That is exactly what big tech is doing with electricity right now. They are purchasing existing nuclear plants directly. They locate their massive servers directly on the power plant property. They keep the generated power entirely for themselves before it ever touches public transmission lines. This completely bypasses the primary utility grid. It leaves everyday citizens fighting over whatever baseline power capacity is left in the system. We are already seeing the devastating regional consequences of this market asymmetry. Down in Texas, regulatory grid monitors have raised severe alarms. Localized data center activity has violently expanded across the regional ERCOT grid. This creates unprecedented reliability risks, pricing volatility, and rolling blackout threats for everyday citizens. To stop the broader grid from collapsing entirely under this weight, utility companies rely heavily on what is known as a capacity market. Think of this market like an ultra-premium subscription service for an ambulance. You aren't paying the paramedics for a physical ride to the hospital today. Instead, you pay a massive recurring cash premium to guarantee they keep a fully staffed ambulance parked in your driveway 24 hours a day. It is there just in case you have a severe medical emergency tomorrow. Regional grid operators are doing the exact same thing. They pay power plants billions of dollars ahead of time, strictly to guarantee they will be available to generate electricity in the future. And because AI has drained the reserves, the cost of that financial guarantee has just skyrocketed. Take the PJM Interconnect, a massive regional grid system that serves 13 distinct US states. The sudden inclusion of new data center power loads for the upcoming base residual auction caused these capacity market revenues to violently spike. The increase was exactly $7,271,197,971. That is an 82.1% increase practically overnight. American utility infrastructure is being pushed to its absolute limit. Capacity utilization metrics continuously show a fragile system. It is struggling immensely to match the rapid onboarding of these mega facilities. Because of this intense demand shock, the wholesale cost of electric power production is hitting severe and volatile upward spikes. This is tearing through municipal energy budgets. And here is the most critical point. The utility companies are not absorbing this $7.2 billion premium out of their own profits. Under current regulatory frameworks, they are legally permitted to pass this structural deficit directly down to the retail consumer. This results in a dramatic, sustained surge in everyday residential electricity costs. The average citizen is unknowingly subsidizing the energy requirements of artificial intelligence. The crisis has now moved from the concrete physics of the power grid straight into the opaque, high-stakes mechanics of Wall Street finance. The terrestrial grid is completely tapped out. The technology sector knows this intimately. That is exactly why mega-cap companies have publicly committed to spending well over $300 billion on AI infrastructure in 2025 alone. They are desperately trying to build out physical power capacity before the terrestrial grid locks up entirely. This dynamic has triggered the ultimate geopolitical capital allocation race. The United States has aggressively deployed over $227 billion in venture and private equity capital directly into artificial intelligence infrastructure. They are desperately working to maintain a strict technological and economic edge. In direct response, China has directed $138 billion toward building out their own parallel, sovereign digital ecosystem. State-backed initiatives and elite private equity firms are fueling the early stages of this global arms race. But the ultimate liquidity provider keeping this trillion-dollar machine running isn't a Silicon Valley venture capitalist. It is the everyday, middle-class retail investor. When a conglomerate like SpaceX realizes that harvesting continuous solar energy in low Earth orbit is the only physically viable path to powering a 1.96 gigawatt data center, they require a level of liquid capital that private markets can no longer provide. They need the massive liquidity of the public markets. But modern public equity markets are no longer driven by individual stock pickers analyzing quarterly balance sheets. They are completely dominated by massive, automated passive fund inflows. The heavy concentration of mega-cap tech stocks has effectively broken traditional price discovery. This constantly forces underlying index valuations upward, regardless of the individual fundamental health of the companies involved. When SpaceX finally launched its IPO just days ago at a massive $1.75 trillion valuation, algorithmic institutional mechanisms were instantly triggered across the entire global financial system. Under the strict regulatory frameworks governing passive capital, the Nasdaq 100's 15-day inclusion rule and the FTSE Russell 1000's 5-day fast entry rule were forcefully activated. This creates a compulsory, legally binding buying scenario on a macroeconomic scale. Trillions of dollars quietly tied up in passively managed 401k accounts, teacher pension funds, and municipal retirement plans are now legally compelled to allocate immense capital directly into SpaceX stock within exactly 5 to 15 days of the IPO. It does not matter if a public school teacher in Ohio genuinely believes in the long-term viability of an orbital GPU cluster. It does not matter what their individual financial risk tolerance is. It does not matter if they would vastly prefer conservative, dividend-yielding utility stocks. The rigid structural rules of modern index parity dictate that a significant portion of their life savings is automatically extracted by algorithmic managers. It is then deployed to aggressively finance this orbital infrastructure overhaul. The market asymmetry playing out right now is truly breathtaking. The technology sector has successfully socialized the cost of their own energy crisis. They pass the baseline utility upgrades down through your monthly residential electric bill. Simultaneously, they quietly extract your passive retirement capital to fund their limitless expansion into the exosphere. Whether this is a stroke of unparalleled visionary infrastructure genius, or the absolute greatest capital misallocation in modern economic history, remains to be seen. But one fact is no longer debatable. The era of traditional aerospace is definitively over. The final frontier is no longer a destination for pure human exploration. It is no longer a theatre for scientific curiosity or national pride. Space has been entirely repurposed. It is now just real estate for the cloud, and you are the one paying the mortgage.